Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. And it's a bunch of factors, including the high frequency data around the economic activity, earning season that has gone by, and lots more that we will talk with Sushant Bhansali of Ambit Asset Management. He joins us right now on the show today on Talking Point. It's great having you, Sushant. Thanks for taking the time out.
Thank you, Neeraj. Thanks for having me here.
The pleasure is ours. So I was trying to piece together all that's happening. We're seeing decent GST collections for sure, and which is probably an indication of what's happening. But more than that, gasoline demand and diesel demand at 5-year highs, as per a Morgan Stanley report that I read this morning. Yesterday, there was a note which suggested that power demand has hit an all-time high on the 8th of June. There is some high frequency data which seems to suggest that economic activity is moving along at a decent clip. What would this mean for, one, the economic indicators, and two, what could it mean for the markets?
Sure. So it's not just power demand. I think probably fuel demand as well as rationalization is commodity prices, which is leading to, I think, a GDP number which surprised almost everyone, the Q4 GDP number, and thereby the GST numbers, which are also sharing the same story. What it seems to suggest that while the world is in dismay, or are there when there are fears of recession globally, India is just standing out. The Indian economy has been very resilient in the past 12 odd months when there have been recession fears globally post the Russia-Ukraine geopolitical situation. But post that, the Indian economy, which is primarily domestic consumption based, where we have definitely taken some hit on the export side, primarily on probably pharma and chemicals a bit, in addition to the electronic goods. But overall, the domestic economy seems to be booming. We don't seem to see what is happening around, and the Indian business community has probably pressed the accelerator on the gas and has been moving forward. The demand don't seem to be coming down at all. What was fearing that the Q4 when we started FY23 was that the Q4 probably will be quite benign. That doesn't seems to have come out true, and we have lots and lots of I would say macro, which is almost I would say giving markets new hopes that FY24 will be a new high for the markets, and we will probably end FY24 with a much higher number on the indices as compared to what it was last year.
Sushant, I know we are not in the business of predicting what the index could do in a month's time, but I'm just trying to understand the trading activity has been fairly fervent in the last 30 to 60 odd days, with the broader markets actually doing really well. We've climbed nearly 2,000 points from the lows of 16,800. Does it look that the structure is a bit heavy currently, and therefore there could be a corrective move also on the basis of valuations, or do you reckon that the momentum is in favor of Indian markets currently? What I'm trying to get at is that all-time highs that we're speaking about, will they be get achieved in the current momentum, or do you believe we are set for a bit of a corrective move because of the valuations that we are at?
Sure. So, Neeraj, if you see, while the indices remained in the range bound for last 1.5 odd years, since September 2021, the indices were trading between 18 and 16,000 for a long period of time. But if you look at what has happened till March 2023, when sort of it bottomed out the markets, and from there on we have seen a big jump in indices. But more importantly, many stocks which have delivered probably 2x or 3x of index returns, and more in the small and mid cap side as well. But if you do a flashback and see what has happened to almost all of these stocks before March 2023, you will see that index only suggested probably a low single digit drop from the peak. But most of these franchises were having about 15 to 35% corrections from their highs in late 2021. So this is more of a mean reversal, market recognizing that there is an opportunity, while the earnings for last 1.5 years has played out well, and these companies have delivered healthy earnings. And that's why they're getting rewarded, and the valuation gap, which was there in March 2023, that seems to be going out, and we are seeing probably a new wave coming through on the market side. And the other interesting factor is, while these franchises had a sort of mean reversal play. The bigger play probably is that the FPIs have started coming back. For last 3 months, we had positive inflows, and the May 2023 was really big. We had almost 35,000 crore plus of FPI inflows, and while they didn't disturb the market beyond a point in the last 1.5 years when they took the money out, but of I would say a small dose like this has taken everybody by surprise, and people who were waiting on the sidelines started having FOMO, and they've started playing out quite well. Just give me a second.
Yeah, sure.
Yeah,
Okay.
so,
No problem. These phone rings can be disrupting at the best of times as well. Now, Sushant, I was trying to think, therefore, where is it that you guys are finding favor? And I want to start off with banking, maybe, because that's the heaviest weight. The overarching belief was that NBFCs come to the fore when in a period of maybe falling interest rates, though it seems that for the rest of the year, the RBI may not move the pedal too much. But for banks, because of the earnings growth momentum, as well as the point that you guys have made in your note, the Groundhog Day, when you've spoken about how the deposits for banks will look robust because of this 2,000 rupees note withdrawal. What is your stance at Ambit Asset Management on banks versus NBFCs currently?
yeah, so we are fairly positive on both sides. I would say that if you look at post-COVID, BFSI was one sector which participated the least. And the rally in the last 1 year, especially on the bank Nifty side, has been more led by public sector banks than by private sector banks. If you look at the stalwarts of private sector banks, not many have delivered much in the last 3 years or so. So I would say, earnings have delivered quite well, and their valuations catch up is yet to happen. So we are fairly positive on private banks from here on. And on the NBFC side also, if you look at barring one or two NBFCs, which are probably trading at lifetime highs, most of them are trading between 10 to 50% below their recent highs in the last 1.5 odd years. So there is a fair lot of catch up yet to happen in both sides. And from an interest rate perspective, I would say that the pressure on NIMs, which seem to, I would say, is now behind us, because the interest rates have sort of paused globally, as well as in India, we had almost 2 consecutive pause. And while the RBI, the central bank, has said that they are not looking to reduce the rates in a hurry, and they will want to achieve the inflation target rather than being in the range, giving them comfort. I would say that the pressure on NIM is certainly out. And even the lending rates have slightly corrected in the last 1 month. Say about a few bips, but that itself is a healthy sign that the demand is quite strong, and the deposit growth, which was, I would say, lagging behind in banks for a few months or quarters rather, should be now aided with the 2,000 note withdrawal. Some positive impact on bank deposits. The money will circulate, in our view, first as a bit of consumption, because not much of these notes was in public circulation, and if you look around, and most of this is probably trending way more towards, I would say, consumption than on deposits, but ultimately they will become bank deposits as such, and which is where we believe that some gap on the credit growth versus deposit growth, which was leading to higher interest cost for banks and NBFCs, will get a bit settled down.
Interesting. Now, they are primary higher economy activity beneficiaries, Sushant. What else do you reckon benefits? Because we've seen specific pockets. I mean, the markets have priced capital goods, for example, to near perfection. I think, say for one or two, most of the MNC names are priced to near perfection. So that bucket, I don't know if it's investable. So I'm trying to understand, within your portfolios, how are you capturing the higher economic activity?
Sure. So the private capex cycle, there are very few players who have been quite, I would say, investable from our point of view, which means that good capital allocators, which means that their corporate governance norms are quite good, and which means that they have sort of moduled their business model in a way that despite cyclicalities of the sector, they're able to consistently grow and deliver healthy ROCs to their shareholders. So that investment from our side is very small. But what we try and do is that to take advantage of these cycles, we look at the first derivatives and second derivatives. So give an example in terms of real estate, which again is a cyclical sector. We primarily try to invest in building material companies across the sphere. And interesting point on the real estate side is that there is no national level player which can help you play the cycle. For each micro market, there is a player, and each micro market does have its own nuances. And so that's why a real estate cycle coming good not necessarily helps a particular micro market for its own reasons. Right, but in the building material cycle, whether it's on the tiles or whether it's on paints or whether it's on sanitary ware, etc., etc., there's so many players which are pan India and which can give you a benefit of playing the cycle if you are able to catch it at the right time.
Got it. Okay, so real estate and the beneficiaries of the cycle predominantly, the ancillaries seem to be a clear pocket out there. Fair point. The other one, I was noticing some of the notes that you guys have come out with in recent times. There is a bet that the Ambit Asset Management team seems to be making on companies which are in the garmenting space as well. There is, of course, a clear reference to the key leader, but all of these companies have seen some stress in recent times. So this is kind of veering towards consumption now. So before I come to rural and beneficiaries thereof, wanted to talk about this specific pocket, Sushant. What gives you guys the confidence that some of these undergarmenting companies, as the case may be, or leisure wear companies might actually do well?
Sure. So we have seen. So what we tried to come out with that note was more meaningfully that the cycle seems to be out of flavor for the business leaders because of intense competition, which has restarted, which went, I would say, quite benign for post-COVID, right? And we have seen across the sectors. It's not just innerwear segment. I would say across all the organized sectors. What we saw that there was literally zero or no competition in 2021 and 20, which led to a bit of competition in 2022, is fairly active now. There is intense competition across categories, and all the organized side which had a home run in 2020 to 2022, they are now sort of responding to intense competition, which is leading to a bit, I would say, clamp down on their either growth of revenues or on their margins, one of the two, because which is where either they protect their margins or they protect their market share, and each player will have their own strategy. Leading to that is that the EPS growth does get affected, and which means that all of these players mostly trade at quite high valuations, and there is very, I would say, thin line on which they've been dancing sort of on thin ice. And that's where probably, given that 1 or 2 quarters of benign growth in EPS leads to some bit of correction. And our view is that times like these are good opportunities for investors to get into a few of these great franchises, which have time and again shown us that they do respond to competition and they come out of it in a much better way as compared to everybody else. And they've been testing this for 5 years, 10 years, and 15, 20 years as well. So they've seen many such cycles, and slight corrections on cyclicals because of competition to these great franchises are great investment opportunities in our view.
Got it. The last aspect, Sushant, is on the rural story. Now, there is a belief that a pre-election year would mean positive outcomes for anything focused to rural, because there will be spends done out there. MSP hike was probably one such example, but there will be more in store possibly. The commentary from the companies is talking of green shoots, but at a very early stage. But the FMCG index has rallied YTD much more than what the Nifty has done. I would love to understand, how do you think about rural consumption plays, be it FMCG, be it two-wheelers, be it whatever else?
So rural has been into distress post-COVID as such. And because we saw a lot of migration or rather reverse migration happening, and then again migration started happening as we are seeing in the unorganized sector also coming back, and which is where most of the migrant workers go out. While we had a good set of monsoons for last few years, but there were I would say apprehensions regarding monsoon this year. So far, I would say that still the hope is that monsoon will be just about average. There will be pockets where they will be good, and there will be pockets in the country where it will not be that good. But there were depressed conditions on the FMCG side. They got hit both by demand on the rural as well as commodity prices going up sharply post the Russia-Ukraine situation. And what we saw that as crude starts coming down since last few months, the margins of most of these companies had, I would say, healthy advantage to play out for the next 2 quarters, and they were giving great valuation comfort to market participants, and that's why we saw the rally which happened in the last few months on the FMC side, especially. Coming to demand on the rural side, I would say it will be aided while there was a big respite. Just to add that on the budget side, when all of us, I would say, were quite relieved that the government presented more capex-focused budget than as compared to a lucrative budget, right? We definitely, I would say, were expecting some of these moves like MSP increase like these. We have seen in both 2013-14 as well as 18-19 that some of these things will play out as to ignite, I would say, the rural demand and make it a feel-good environment, if not freebies, right? Because it's not being given to anyone and everyone. Only people who probably would bring their crop to the market will be able to participate in this. So it's much better outcome as compared to doling out freebies in the budget reallocations. But definitely we'll probably see one or two more such moves come from the government side to aid the rural economy. And while election is an enabler and probably a motivator for government to do these things in probably a short span of time, compared to doing it progressively over a long period of time. But definitely, I think rural India needed such a booster because there was distress for the last 2 or 3 years. And if we don't have a great monsoon this year, the enablers like this will probably help us retain or probably grow the demand on the rural side.
Got it. Sushant, before we wrap up, what's your how do I say, a dark horse bet, if you will, something where you guys are either playing contrarian to what the market believes, or you are majorly overweight relative to what the market might be, even if the market is also bullish? What is that particular theme? It may be a small part of your portfolio, so be it. But where is it that you are at odds with what the market is believing currently?
Sure. So there are two sectors where we would say that the dark horse thing can play out.
Okay.
One is chemicals and the other is IT.
Chemicals?
Right. Yeah, chemicals and IT. Chemicals have not participated, if you look around, for last 2 years.
Yeah.
At least, right? And they participated quite well between 2017-18 till about COVID times, right? Pharma also has not participated, but the global business, we are not yet fully comfortable. Chemicals is something which we believe it's more investors' view of how things have played out than the real franchise value of most of these players. If you look around, they have been able to pursue the capex. Most of the players, at least, have been able to pursue the capex which they announced, looking at the great demand which they were expecting for the next 5 and 10 years. Which means if the capex has been done, the revenue shall follow, because most of the capex does happen basis, I would say, contracts with customers, right, which are not probably fully dotted and signed, but probably well in pipeline, and that's why the capex has been done. So chemicals is one sector where we believe that it can be the dark horse for FY24. And IT, I would say that valuations do give comfort, and but IT is not that hard horse as compared to everybody. It's not a contrarian bet, I would say. Many investors probably are happily accepting the fact that the valuations on IT companies are very reasonable. And in this market, when as Nifty and Sensex are towards again their peaks, probably they give more comfort than many more sectors on the valuation side. The growth trajectory might not be that great for the next few quarters, but timelines beyond that do I would say investors a good reason to invest into these franchises.
Got it. Okay. Sushant, great talking to you as always. Thanks so much for taking the time out and being with us. And look forward to talking to you more often.
Thanks, Neil. Thanks for hosting.
The pleasure is ours. And viewers, thanks for tuning into this edition of The Talking Point.